afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Readings Tuesday afternoon webcast. Please, we are so excited to have a special guest star join us today in lieu of David's absence. Joining us is Diana Avador, Vice President, Portfolio Manager, and Head of Trading at Barometer. Diana was recently featured in the Globe and Mail's article, Bulls and Bears Square Off over stock market's direction, where she discussed investment strategies in the current market environment. We look forward to speaking with Diana about her take on the market, where we have come and where we are going. Long, medium, and short-term time horizons in light of the market's recent volatility will be touched upon. And we're pleased to have James Callahan joining us as well to join in the conversation with Diana. James is one of our key analysts on our trading desk. So we're bringing you the eyes and ears of Barometer's trading desk today. So please don't be shy. Feel free to email me your questions. You can email me at phastings@barometercapital.ca or send me your questions via the Zoom chat. And with that, I turn the conversation over to Diana Avador. Diana, thanks so much for joining us. We're so pleased to have you and look forward to your insights today.
Thanks, Pamela, and thanks for the kind words. Appreciate it. Well, welcome to Barometer Readings. I'm thrilled to be here. Love talking markets. And if there's any questions at all, please don't hesitate. If you have the question, you can rest assured that everybody else is asking the same thing. So no question is not good. So feel free, and we'll take your questions at the end. And with that, why don't we just begin? I want to go through a little bit of the long term and then medium term, and then of course the short term. Some of you that have been on this call before will know our basic idea of where we are in the long term situation, and then we'll go through. And the reason some of these things are important, the reason we watch the short term, or I watch the short term, is really it's important because they tend to bleed into each other. Everything was short term at once. Before it became a medium-term issue, either positive or negative. So we watch, and then if it disappears, that's fine. But if it bleeds into medium-term, let's say, then we act. So for example, once we identify a short-term phenomenon, we follow it to see if it has staying power. If it does, then we react. And how a market reacts to some event gives us an understanding into the medium and long-term view. For example, last week we had an important week. We had a Federal Reserve announce that they are soon going to start tapering what has been an incredibly accommodating policy. And a taper that is taken well by the market points to a confirmation of our long-term belief that we've probably seen generational lows in rates. So we will talk about what happened the past week, and we'll touch on Evergrande as it has been in the news, and people are watching the fallout from there, some flows and what actually matters, and then what we're watching going forward. Earnings season is coming up as well, and portfolio positioning, of course, which James Callahan will go through shortly. So let's begin. We, of course, follow a process. We decide our market trend, then we identify where the leadership is and invest in the leadership without bias. We watch all those elements I discussed before, and short-term, medium-term, long-term, and if there is a change, we recognize it and we adjust. And finally, if some short-term element bleeds into medium-term and changes a fundamental outlook, we are prepared to play defense. We have no problem adjusting. We will not dig in our heels. So what's the long term? Fundamentally, we believe that we are in a structural bull market. This can last a very long time, not days or weeks, but years, as you can see. People talk about the length of time this bull market has been going on since March 2020, since COVID has taken us down quite substantially. And since then, we rallied. We've looked back a couple of times, but not by much. In the bull market, this can go on for more than a decade. This one started in 2013. And maybe the reset was 2020. We'll see. Furthermore, we also believe that we have probably seen lows in rates. If not, we have other issues to consider, but we will get ample heads up for that. This takes decades to work through as well, and we are at a point where we have reached generational lows in yields, we believe. So what about the medium term? We have dovish central banks, lots of liquidity in the system, and let's take a look at the following data points. We have $120 billion. That is the amount of bonds the Federal Reserve is buying per month. That is going to be tapered. We have $15 trillion. That is the amount of global negative yielding assets. $4.5 trillion is the amount of cash on the sidelines in money market funds earning zero return. And 30% is the amount of stimulus checks still that individuals have not have spent. And finally, that we have a negative real yield in the US bonds. Inflation adjusted, bonds lose you money. So here are the US Financial Conditions Index as measured by Goldman Sachs. A very dovish Fed, therefore easy financial conditions. And by the way, this is a global phenomenon. It's everywhere. So what happened the last week or so? We have had a central bank taper. Last week brought decisions from a number of central banks that signaled the exit from emergency monetary policy settings. Last Wednesday, the Fed gave advance notice that a reduction in the pace of purchases may soon be warranted. About Evergrande, the Chinese property company owes $669 million of coupon payments for the remainder of this year, with $83 million due last Thursday. No one knows yet if those were paid. Probably not. People are watching for global fallouts. Fair. So far, it looks to be contained. Experts are explaining that China's economic system is different than the open economies we know. Victor Schwetz from Macquarie, who has been following China and Asia for a very long time, he stated very eloquently that there is no real difference in China between public and private, state or non-state. China is an integration of the two. Therefore, the crisis can be contained in minutes, unlike here, where it has to go through the system. So far, we have not seen any bleeding through to our system. Let's go through some pictures for this and discuss some of the rest of the points. Markets are characterized by the way they absorb news. On September 22nd, this was the headline: tapering coming soon. Normally, that would be a problem. How did the market finish up that day? Up 1%. Even though bond yields rallied, rates are higher and markets are higher, normally that would not be. But this is different. We're coming off extreme lows. And actually, market sold off in anticipation of this event. It was down about 4%. Then it rallied, was only down about 2%. And today we lost a couple of percent. So last week was a good week. It would not be the first time it corrected a bit. Excesses do get traded down, traded here and here and here, and we're there again. Excesses getting traded down is not a bad thing. It's a good thing. Nothing is more bullish than the market accepting a taper. So why is it accepting? And what is helping it? Earnings are expected to be pretty good. This is a chart that shows us analyst expectations. So for September, that's your green line. You can see analysts have moved on to the earnings expectations that the S&P is going to deliver. More and more are expecting the year to be pretty good. 7 are expecting between 210 and 220, 4 expecting 220 to 230, and 4 expecting 230 to 240. Costco, for example, reported last week a very good report. Despite being against very high comps, it still beat. So we have earnings support. This is the estimated next 12-month S&P 500 operating margin. Supportive. Market rebounded 2% after the FOMC. This was the day of the FOMC. There was some shorting or hedging ahead of that. This was the 21st. This is the 22nd, day of the taper. If taper worried anybody, it would not be up. Then there was some short covering, even higher a few days after that. I touched on the unique situation of Evergrande. So like I said in the beginning, we watch the short term to make sure we don't miss it if it bleeds into the medium or long term. So far, there is no indication that Evergrande is touching the rest of the world. This is the high yield spreads in China, and they've really elevated as a result of what's going there locally in the property sector. It didn't bleed into the CDS market. This is the 5-year credit default swap for Goldman Sachs and Citi financials. They should be affected. Companies are flush with cash. They're doing buybacks, they're paying dividends, and the balance sheets are healthy. It didn't bleed into the US corporate spreads either. They're benign, no widening of spreads. What else is working? Buybacks. Now, some companies will go into their quiet period ahead of earnings, which is what we're going to get soon. And you will be hearing maybe some headlines as to how market can get a little bit sloppy since there's no buybacks. That is true. It can happen, but they come back. And the large buyback corporates, which is the large financials and the large technology companies, those actually do their buybacks on an automatic basis. They go throughout the whole earnings period. But people like to trade ahead of what they think might impact. So sometimes a headline does have the impact of actually happening, but it tends to be short-lived. Boots on the ground, flows and exposures, what's happening in the market. We've had one of the largest annual equity fund flows coming into equity markets as a result of all those things that I mentioned in the medium term, such as all the cash on the sidelines, all the cash in savings, people working from home, saving money, young people going and living back at home, saving their $1,500 or $2,000 rent checks and actually entering the stock market, which is not a bad thing. We have exposures to equities on a portfolio basis. This is from Bank of America, Merrill Lynch, Global Research. Their high net worth individuals are very nicely invested in the stock market, pretty high since the chart has started in the series in 2005. They also have a fairly low exposure to bonds, as if we're right, and we've seen generational low in bond yields, the bond market is not going to be a very lucrative place to be from an investment perspective as rates do move up. And I want to touch a little bit about rates moving up. Everybody tenses up when we think about that, but rates coming from 0 to 2% is not a big deal. It is a 2% tightening de facto, but it is for the good reasons, which is growth. Growth is a good thing. There is still room to grow in employment. So the big chart here is where we were before COVID. Going in the right direction, not quite there yet. Accommodation is being only slowly and gradually moderated and can be put back if needed. And that is actually an interesting concept. We are in a good spot to start tapering. And I don't believe that the tapering will have too much of a negative impact when it offsets growth. And to have something to be able to put back, that's also not a bad thing to have in your toolbox. In terms of flows, there has been little interest in cyclical sector. We've had a rally and then a slowing off as there was some concern over growth. And this market has taken very big rotations underneath the index surface. So when cyclical is selling off, growth takes off. And when growth sells off, cyclical takes off. And that's why you're seeing the index actually pretty flat and at highs, when underneath it there has been some decent corrections, and actually highlighting the need to be in the right neighborhood at the right time when you're investing. This can be underneath the surface. One of the reasons this is also happening is because the FANG stocks, as they're called, the large, the very, very large caps that are now a big portion of the index. So the differential between them and the rest of the index is now pretty high. So if cyclicals didn't work, why is oil rallying as much as it has? This chart shows you to about 73.5. We closed today at around 75. And it really feels like there is a buy of dips mentality here. Dips are being bought. ESG concerns are being downplayed a little bit. This is a market not in balance from a supply-demand perspective. Toughening emission standards are creating a bit of a shortfall. And some energy companies, a lot of energy companies, are doing very well on $70 oil, never mind 75 or 80. Production can't be ramped up very quickly. Operating rigs are in very low numbers, and there has been very little investment in the sector in the last few years. We have seen immense flows into the NASDAQ 100. This is always a favorite sector. This is where growth actually happens in a very big way. Now, we're watching this for a little bit of a rollover, just because there's been so much exposure. It's possible that, you know, some gets taken off. Today, we've seen a 2% sell-off in the NASDAQ as yields are rallying, and some of these, there's profits to be taken. But again, we're looking at things to see what a short-term phenomenon that will bleed into the medium term, because if not, then this is just a regular correction. Market has shock absorbers in place, and selling is not a problem. It's how it's being absorbed that is interesting. Tech earnings have outstripped the global market. This is World Tech Media, Telecoms, and Amazon in earnings relative to the rest of the world or to the rest of the sectors. And this is return on equity. So we see why they're loved so much. There's been growth, there's been earnings, there's been even dividends, and there certainly have been buybacks. So tech did okay with a little bit of a sell-off ahead of the taper. Here, it has come back, and today we're closer to the 50-day moving average, and that is kind of what we're watching to see that it holds right there. Flows into the S&P 500 have been high. And financials did very well last week, a favorite sector of ours. S&P flows have been positive. Now, we're having a little bit of a messy day today, so I want to just mention this. So flows are positive, very high. They've been high here too, and high here too. We've had a little bit of a correction, but the trends have held. This actually was the COVID sell-off. And so we're here. It's okay if we have a 2 to 5% correction. Underneath the surface, it will feel like more. But if it's holding and shock absorbers are holding, we have this trend and growth is happening and earnings are happening. So you got to put it in perspective. We have the individual investor engaged, both in terms of, investing has become democratized. A lot of people are doing short-term trading. Like I mentioned before, COVID has created a situation where people have a little bit of risk cash. They're living back at home. They don't have to pay rent. And people are very, very engaged. This is another chart that shows another indicator of robust equity market activity. This is the average daily stock option volume. Really, eyeballs on the market and interest provides for liquidity, provides for a good price discovery. It tends to be a positive. And to be fair, both bonds and equities received inflows. This is a testament to the easy financial conditions. Money is abound, and it finds its way into everything. Economic data was shy of expectation for a long time. This is the Citi US Economic Surprise Index. This can be a little misleading because you see the chart going down. It means that the economic data did not meet expectations, but it doesn't mean it didn't go in the right direction. And this actually tempers inflation expectations. And inflation expectations are actually the prelude of inflation. If people expect inflation to occur, then they buy more now. So inflation expectations are the one step before actual inflation. And we're of the opinion that we will be seeing, and we are seeing, reflation. We're not quite there on the inflation front. Because everyone expects the ultra accommodative policy to taper soon, and therefore markets are holding an even light of data that misses expectations. So as economic expectations, data has missed expectations, this was holding. It did not sell off. Points to the fact that people believe that it will continue to go in the right direction. Yields have rallied from 130 to 150 almost. Actually, it's 153 today. Markets off 2%. Not bad. These are the yields in Canada since the Canadian elections and the Fed meeting. They've also moved up. Actually, the Canadian Central Bank announced that they will be being less accommodative before the Fed. And on the theme of a good market is characterized by the way it absorbs news, the day before the FOMC, there was a risk taking. The FOMC announcing a taper, we end up 1%. The day after, we cover all the shorts, and then we just stay, and whoever didn't manage to do, just nothing happened. This is the TSX 60. It also had a little bit of a hedge scare, but it has since come back, and oil is helping it. Money is being put to work all the time. This is just a headline from Bloomberg, the day of the FOMC. Trader just spent 50 million on bullish option tied to the S&P 500. We're seeing activity that is supportive. And things to watch. There's always things to watch, and it's important. So every day that Evergrande is not blowing up globally, the market is doing a little better. Today we have a little bit of scare on the debt ceiling and yields moving a little higher. This is the number of stocks that are trading above their 200-day moving average, and has come in a little bit, which is okay. It has happened before. It has happened right here. It has happened right here. Markets don't always sell off on this. They can moderate. They can stay flat. or they can take 2 to 4%, like I said earlier, and that's okay. And then if it holds, it cleanses the excesses. What we're watching for is for the S&P to hold the previous low, which was on the 20th. We are not there yet. We've traded down today, as you can see by the chart, but this is where we're wanting the short term to hold before we consider whether it has bled into the medium term. Volatility, a measure of fear. We're watching for it to face resistance here. If it goes much higher, then we start considering whether it's bleeding into the medium term. And then bottom line, there's always things to worry about. I think we can have a small correction. Actually, we had a little bit of today, but everything points to it being viable if that happens, all else equal. The economy is growing a little more, a little less. I don't think there is appetite for lockdowns anymore. Should that happen, we'll have to reassess. Though I feel like if you're vigilant about your sector exposures, there are places to be in different economic scenarios. We've seen how well the work from home stocks worked. Flows have been supportive. Now, flows are a lagging indicator. Flows last week were negative. The direction doesn't bother me. What I watch is how they are absorbed. And last week they were absorbed well. For now, they're good, but we're watching. We will make sure that if the short term bleeds into the long term, we will adjust as our process dictates. So market is moving in the right direction. It's absorbing news well. It's waiting. We're watching the earnings season to see how it's going to pan out. We think that it's going to be as expected. We're waiting to see next month if the taper is announced. We think it will, barring any blow-ups, like say something happens with Evergrande or any kind of thing that is contagious, but doesn't look like it does, or it will. We're watching to see how some excesses get worked through. I've touched on it a little bit today. And should there be a correction, will the shock absorbers hold all that cash on the sidelines, negative yield, all that interest in equities, the negative return on bonds, and then if we'll always follow the process. If market leadership changes, we'll change and we'll adjust. And if the short term bleeds into medium term, we will be prepared to play defense. And on this note, I will transfer it over to James to discuss a little bit about our portfolio exposures, and maybe James, a couple of stock conversations.
Sounds good. Thanks very much, Diana. So if we could just move to the sector exposure chart. So here are our sector exposures firm-wide across all funds and pools. The only substantial change I'll highlight month over month is that we now have a bit more energy exposure. I do want to point out the overweight in financials, which has persisted for much of the year. Given the move in yields that Diana talked about, a lot of these positions have been working pretty well. And I'll talk about a couple of them now. The tech weight has become a bit larger. Tech had been resilient through some choppy markets last week and through slightly higher yields, but has been a bit weaker this week. So moving on, I just want to briefly touch on a few of our favorite positions in the US. Even after a day like today, there are still some great stocks out there. Certainly for many, the fundamental case to own them remains unchanged. Of course, always being mindful of the charts. So why don't we, just in the interest of time, skip Lattice? We'll go to Silicon Valley Bank. We can save the spotlight on Lattice for another meeting. So for much of the year, the financial sector has been consistent standout leadership. There have been many great industries we've sought exposure to beyond just banks, like rating agencies, insurance companies, index providers, asset managers, and maybe we talk about those another day as well. But right now, I just want to double click on the banks. So broadly speaking, there are two different types of bank stocks that are great to own here. The first, given the move in yields, are the bigger money center banks like JP Morgan, Bank of America, Morgan and Goldman. Our favorite is probably Morgan Stanley. So we'll have a look at that. But these money center banks in a rising rate environment, they're seeing expansion in net interest income. Investment banking and sales and trading revenues have all been really strong. And their focus has been to expand earnings so they can better return capital to shareholders. They're all reducing share count through buybacks and growing their dividends in a big way, especially right now, because they all carried excess capital through much of last year and into the first half of this year, just due to the economic environment. Now that things have smoothed a bit, they can start to take down their capital ratios. So specifically on Morgan Stanley, just some comments. Among large US banks, they're lower down on the rate sensitivity scale. So net interest income was only 13% of revenue last quarter, which is why they outperformed other banks through the middle of the year when interest rates took a pause. We primarily like them for their investment management and wealth management business. They have about 2.6 trillion AUM now, so they're seeing great inflows. They're also growing their fee base through really good performance. We're now just about a year past the E-Trade acquisition, so that's helped investment management asset growth. And their capital markets businesses have held in really well despite lapping incredibly tough compares from Q2 2020, where they really blew it out of the water. So continuing to beat expectations there, and in trading and investment banking. Also relative to peers, they had one of the best outcomes post Fed stress test results. So Morgan Stanley doubled their dividend from 35 cents to 70 cents after successful completion of those tests. So growing earnings, returning more capital, and that's a great name to own. And then the other type of bank, which you really only see in the regional group, and this type, because they're operating in a region or in a niche, or they're just managed well enough that they can get some loan growth. These banks actually have a use for capital. They can go out and make new loans and grow. They don't want to be returning capital to shareholders. In many cases, they actually tap equity markets to raise capital. And Silicon Valley Bank falls into this category. So maybe if we could just go back to that chart quickly. I've talked about it before during these calls, but maybe a quick refresher. They operate not just in Silicon Valley, but really anywhere you see innovative companies. They generally add early stage venture and private equity backed companies as clients early on, and then retain them as clients as these companies grow, and provide increasingly more service as the companies get larger and larger. And something that Silicon Valley Bank does that's pretty uncommon, and has actually paid off big for them. They'll take warrants in client companies, and as these companies grow, they can realize appreciation on their warrant holdings. So Silicon Valley Bank's still growing like crazy, expanding product offerings, and it's still a great environment for venture capital and private equity backed companies. During the second quarter, they put up 8% loan growth. So high single digit loan growth, really strong. Bulge brackets mostly have flat loan growth right now, flat to slightly negative. Client funds grew 18%. Net interest income grew 11%, which is material for them because they are primarily a corporate bank. And fee income grew 8%. So during the first half of 2021, Silicon Valley Bank booked $700 million of warrant investment gains. So that strategy is working out well. No dividend, and they are a net issuer of shares, but they raise capital to take advantage of growth opportunities they're seeing. Like another one of our holdings, First Republic Bank, we like them for the loan growth and business line expansion, not for return of capital to shareholders like some of the other banks. Besides that, right now they're just digesting the acquisition of Boston Private they did earlier in the year. That expands them into private banking and wealth management, which we like. So that'll bring about $330 million in private banking and wealth management revenue. And now we know now that they're building out an investment bank as well. So they poached some senior investment bankers earlier in September to begin building that out. And that really is the last piece of the puzzle for them. So that makes them a one-stop shop. And they should be losing less business now to the bigger banks as a small venture PE-backed company grows and needs things like advisory or needs to go public. So that's Silicon Valley Bank. And like I said, even in this type of market condition, we're still seeing some stocks exhibiting leadership characteristics. They've just gotten a bit harder to find. And I think this brings us to the end of the program. So maybe we could take a few questions.
Well, you guys certainly did a great job addressing the current market conditions, and for that we thank you. We don't have any questions to speak of right now, but as always, if you do have questions that come to light later this evening or after you watch this webcast, please don't be shy to email us at phastings@barometercapital.ca. We'd be happy to address your questions offline. And with that, I'd like to thank James Callahan and Diana Avador for graciously attending this evening's webcast. And with that, thank you so much, Diana. Thank you, James. Always a pleasure to have you join us. And
Thanks,
with that, I
Bev.
leave you to have a wonderful evening. Thanks again.
Thanks, everyone. Goodbye.
Thanks all.